Ever wonder how startups get their big break? Or how investors make their millions? It's not just luck or magic, it's venture capital and angel investing. These two financial instruments are the lifeblood of the startup ecosystem, pumping funds into promising new ventures and helping them grow from humble beginnings into global powerhouses. Venture capitalists and angel investors are like gardeners, planting seeds of capital in the fertile soil of innovation, watering them with guidance and expertise, and watching them bloom into successful enterprises. But the path to success isn't always smooth. These types of investments come with their own unique challenges and risks. However, the potential rewards can be astronomical, turning a modest sum into a fortune. So, are you ready to embark on this journey, to unearth the secrets of venture capital and angel investing? Stick around to learn about the thrilling world of venture capital and angel investing. First off, what exactly are venture capital and angel investing? Venture capital, or VC, is a form of private equity financing that is provided by venture capital firms to startups and early-stage companies that have been deemed to have high growth potential. On the other hand, angel investing involves affluent individuals, often called angel investors, who provide capital for a business startup, usually in exchange for convertible debt or ownership equity. Now let's delve into the key differences between these two. The first major difference lies in the source of funds. Venture capital firms pool investment funds from various sources, such as corporations, pension funds, and wealthy individuals. Angel investors, however, are typically high net worth individuals investing their own money. Next, we look at the size of investment. Venture capital firms usually make larger investments, often in the millions, while angel investors typically invest lower amounts ranging from a few thousand to a few $100,000. The level of involvement also varies. Venture capitalists often take a hands-on approach, with a seat on the board, influencing strategic decisions. Angel investors may also offer strategic advice and networking opportunities, but their involvement is usually less formal and less intensive. Lastly, the risk profile. Both venture capital and angel investing are high-risk investment strategies, given the high failure rate of startups. However, the risk is generally higher for angel investors as they invest in the very early stages of a startup, where uncertainty is greatest. So, while venture capital and angel investing may seem similar, they offer distinct opportunities for both investors and startups. By understanding these differences, one can make more informed decisions about which investment path to pursue. Now that we know what venture capital and angel investing are, let's delve into the stages of investment. The investment journey is a fascinating one, with several stages that reflect the growth and evolution of a startup. It all begins with the seed stage, the very inception of a business idea. Here, angel investors often step in, providing that initial funding to help entrepreneurs transform their ideas into viable products or services. Then we move on to the early stage, also known as the startup stage. This is where the business is up and running, and there's a clear business model in place. The focus is on building the product, attracting the first customers, and achieving market validation. At this point, both angel investors and venture capitalists could step in, providing the necessary funding to fuel growth and expansion. Next, we have the growth stage. The business is now generating steady revenue, and it's time to scale operations. This is where venture capitalists typically come in, offering larger amounts of funding to help the business penetrate new markets, enhance product offerings, or even acquire other businesses. The final stage is the late stage, also known as the pre-IPO stage. At this point, the business is well established, with a solid customer base and significant revenues. Venture capitalists continue to play a crucial role, providing the necessary capital for further expansion and preparing the business for a possible initial public offering, or IPO. Each stage of investment has its unique challenges and opportunities. The key for both investors and startups is to understand these stages and to recognize the roles that venture capitalists and angel investors play at each stage. These insights can guide startups in securing the right funding at the right time and help investors identify the best opportunities for their investment portfolios. Understanding the stages of investment helps investors make informed decisions and startups secure the right funding at the right time. But why are venture capital and angel investing so important in the startup ecosystem? Venture capitalists and angel investors play a pivotal role in the life cycle of startups. They are often the lifeblood that fuels the growth and success of these ventures. Venture capitalists, with their deep pockets and strategic guidance, can propel startups through various stages of growth. From seed to late stage, they provide the much-needed capital and expertise to help these businesses scale and achieve their full potential. Angel investors, on the other hand, are typically involved in the early stages of a startup. They provide both funding and mentorship, often using their industry experience and connections to guide the startup through its initial hurdles. But their roles extend beyond just funding. They foster innovation by backing entrepreneurs and their groundbreaking ideas. They are risk takers, investing in businesses when they are just ideas on a piece of paper, long before they become profitable. Moreover, these types of investments are significant drivers of economic growth. They lead to job creation, technological advancements, and the development of new industries. They transform small startups into global giants, creating wealth not just for the entrepreneurs and the investors, but for the economy as a whole. So you see, venture capital and angel investing aren't just about money, they're about belief in an idea and the courage to back it. Without venture capital and angel investing, many successful startups may never have gotten off the ground. Venture capital and angel investing can be risky business. But with great risk comes great reward. The landscape of these investments is packed with both challenges and opportunities that an investor must navigate. On one side of the spectrum, we have the challenges. These investments are high stakes, high pressure, and not for the faint-hearted. The startup space is volatile, and the odds are stacked against success. In fact, a large portion of startups fail within the first 5 years. Furthermore, the lack of liquidity can tie up your capital for an extended period, which might not be suitable for all investors. On the flip side, we have the opportunities. The potential for outsized returns is a significant draw. A successful venture can yield returns many times the initial investment. This is what makes the risk worth it for many. Additionally, it can be incredibly rewarding to be a part of a startup's journey, helping shape its growth and success. But remember, it's not all about the money, it's about the impact you can have. You're not just investing in a business, you're investing in ideas, in people, in innovation. You're contributing to the creation of something that could change the world. By understanding the risks and rewards, you can make smart, informed investment decisions.